Hey everyone, welcome back to Corporate Decoder. Today SAMO just filed an 8K, and I am seeing a key detail about their IPO that investors need to know. Quick note, this is not financial advice, just my take on public filings for educational purposes. This report tells us a lot about how Samos Energy Acquisition Corporation is structured and how their initial public offering went down, including how much money they raised and what agreements are in place. This document is a current report that companies file to announce major events. For Samos Energy Acquisition Corporation, this filing is all about their recent initial public offering or IPO. Think of an IPO as a company's first chance to sell its stock to the public, which is a huge step. This particular filing details the completion of that IPO and some important side deals that came with it. So, who exactly is Samos Energy Acquisition Corporation? Well, this is what is called a Special Purpose Acquisition Company, or SPAC. Basically, a SPAC is a shell company that goes public with the sole purpose of raising money to eventually buy or merge with another existing company. They are essentially a blank check company. Samos Energy Acquisition Corporation is based in the Cayman Islands, but its principal executive offices are in New York. The earliest event reported in this filing is the 9th of July 2026. This is when the registration statement for their IPO was declared effective by the US Securities and Exchange Commission, or CSE. That is a big hurdle to clear before you can actually sell shares. Now, let's talk about what Samos Energy Acquisition Corporation is actually selling. They have registered 3 types of securities. First, there are units, and each unit is made up of one Class A ordinary share and half of a warrant. These units are trading on the New York Stock Exchange under the symbol SAMOU. They also have just Class A ordinary shares trading under the symbol SAMOU. And then they have warrants trading as SAMO-WS. Warrants are essentially options that give the holder the right to buy a share of stock at a specific price in the future. An important detail here is that Samos Energy Acquisition Corporation is an emerging growth company. This means they meet certain criteria set by the CC that allow them to have some regulatory flexibility, especially for newer, smaller companies. They have elected to use the extended transition period for complying with new or revised financial accounting standards, meaning they are not required to adopt the latest accounting rules as quickly as larger, more established companies. This section is all about the material definitive agreements. Essentially, it covers the important contracts the company entered into. The big news here is that on the 9th of July 2026, their registration statement for the IPO was declared effective. Then on the 13th of July 2026, they completed their IPO, selling 20 million units. Each unit was priced at $10. This means they worked with Cantor Fitzgerald, who acted as the underwriter. Underwriters help companies sell their securities to the public, and they play a crucial role in setting the IPO price and finding buyers. And the units themselves consist of one Class A ordinary share and half of one warrant. Each warrant allows the holder to buy one Class A ordinary share for $11.5. This gives investors the potential to profit if the company's stock price goes above that $11.5 mark. This part lists a bunch of other agreements that were signed in connection with the IPO. These include the underwriting agreement with Cantor, a public warrant agreement, a private warrant agreement, a letter agreement with their officers and directors and the sponsor, an investment management trust agreement, a registration rights agreement, an administrative support agreement, a sponsor private placement warrants purchase agreement, and finally, indemnity agreements. These are all standard agreements for an IPO, setting out the rules and responsibilities for all parties involved. This section details unregistered sales of equity securities. This is where they talk about the private placement warrants. On the 13th of July 2026, at the same time as the IPO closed, the company sold 6 million warrants to the sponsor and Cantor for $1 each. These are called private placement warrants because they are sold directly to these specific parties and are not offered to the general public through the IPO. They generated $6 million in gross proceeds for the company from this private sale. Interestingly, these private warrants are almost the same as the warrants sold in the IPO, with some minor differences that were disclosed in the prospectus. The issuance of these warrants was done under an exemption from registration, meaning they did not have to go through the same SEC registration process as the public offering. This is common for private placements to institutional investors or insiders. Here we get updates on the company's leadership. On the 10th of July 2026, Trent Kosowski, Joseph McMonigal, and Kodor Matar were appointed to the company's board of directors. The filing specifies that Joseph McMoneagle and Kodal Matter are considered independent directors by New York Stock Exchange standards. They will also serve on the audit and compensation committees, with specific roles like chairing those committees. The company also entered into indemnification agreements with these directors. These agreements essentially protect the directors by stating that the company will cover legal expenses and liabilities they might incur while serving in their official capacity to the fullest extent allowed by law. This is standard practice to attract qualified individuals to serve on a board. This section covers changes to the company's foundational documents. The company's amended and restated memorandum and articles of association were approved on the 10th of July 2026. These documents are like the company's constitution, outlining its structure, powers, and how it will be governed. A description of these articles is available in the prospectus for the IPO. Regulation FD, or Fair Disclosure, is an SEC rule that requires companies to share material information with all investors at the same time. In this section, Samos Energy Acquisition Corporation is reporting that they issued press releases on the 10th of July and the 13th of July 2026, announcing the pricing and closing of their IPO. Respectively, these press releases are filed as exhibits to this report. The company is also stating that this information is being furnished rather than filed, meaning it is for informational purposes and not subject to certain liability provisions of the Exchange Act. This is where they disclose any other significant events. A key piece of information here is about the trust account of the net proceeds from the IPO and the private placement warrants. $200 million, including deferred underwriting fees, has been deposited into a US-based trust account. This trust account is managed by Continental Stock Transfer and Trust Companies. This is crucial for SPACs. The money in the trust account is essentially held in escrow. It can't be touched by the company until they complete their initial business combination, which is their stated goal as a SPAC. There are specific conditions under which the money is returned, like if they can't find a business to merge with within a certain time frame, which is 24 months in this case. This provides a safety net for the public investors. This final section simply lists the exhibits that are part of this filing. These include all the agreements we touched upon earlier, like the underwriting agreement, warrant agreements, and the press releases. So, what's the big picture here? Samos Energy Acquisition Corporation has successfully completed its IPO, raising $200 million into a trust account. They have a clear path laid out for finding and merging with a target company within the next 24 months. The key for investors now is to watch what kind of business they eventually decide to acquire. SPACs can be very speculative, and the success of the investment largely depends on the quality of that eventual merger target. The structure with warrants and the trust account is designed to protect public investors to some extent, but the ultimate value will come from the merger itself. The risk I am watching is whether Samos can find a valuable business to acquire within the timeframe given the current market conditions for SPACs. What I am actually looking for is the specific industry or company they will target for their business combination. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis valuable, please hit like and subscribe for more breakdowns of corporate filings. Our Discord community is also linked below.